our 2026 Investment Management Outlook in ETF Trends webcast. I appreciate you making time from your busy schedules to join us. My name is Eric Fox, Vice Chair and U.S. Investment Management Sector Leader, joining you today with two fantastic leaders in our practice, Doug Dannemiller, our Investment Management Research Leader, and Paul Kraft, our U.S. Mutual Fund and Investment Advisor Leader. The ideas and insights that Doug and Paul are going to share with you today will help you anticipate and interpret what's to come over the next 12 months in this very volatile, uncertain, and complex time. And this will help you facilitate some critical decisions to drive success in the pursuit of your most strategic ambitions. This is a short webcast, and we hope to have some time at the end for a little bit of Q&A, but please feel free to submit questions through the platform. And if we do not have time to respond to you live, we will surely follow up. With that, I'll hand it over to Doug and Paul. And once again, thank you very much for joining us today.
Thank you, Eric. Thanks, everybody, for joining. Eric, myself, and Paul, if we could go to the agenda slide. Thank you. We're going to talk a little bit about the landscape in the industry and how it's changing. Some innovation that's happening and in coordination with regulatory change. And we're going to talk about the talent landscape, because it's also changing with these new products and services and new technologies being brought into play. The talent picture is changing significantly in investment management. And then, we can't have a webcast without talking a little bit about AI. So we're going to talk about the future of AI and how that's impacting and where the industry is headed with incorporating AI into their businesses and really taking on a governance approach. And then at the end, we're going to talk about the ETF marketplace, and that's where Paul Kraft will take over. So if we could go to the next slide, please. This is our industry convergence slide. And what we're showing here is really three sections where we have traditional products and alternative products. And they're really the coming together in this convergence in the middle with these revitalized products that have been around but are getting new attention and maybe some new stuff. But it's really about bringing together institutional or accredited investors to retail investors and bringing that coming together, as well as converging in the industry where different players in the industry are coming together to offer products and services to this new retail or this new environment for these products in the center. There's a lot of differences that are taking place here. There's regulatory change, there's personnel change, and it's a big deal for the industry. And I think it's opening up a lot of opportunity to gather new assets and to really think about new cooperation in the industry across firms that really were quite separate before. And then I think the final piece is it actually brings in wealth management into investment management in a stronger way than it has in the past. Because with a lot of these new products, the distribution is going to be different, and wealth management integration is going to be more important to success in gathering assets in these new convergence products. So if we could go to the next slide, please. Here, so industry partnerships and regulatory shifts. Industry partnerships are happening to make ETFs work. There's new authorized participants and traditional managers figuring out how to access and source liquidity for their ETFs maybe in a not so liquid marketplace. Partnerships happening across private capital and insurance to get access to those assets and make them managed, more effectively with private capital included. And I think regulatory shifts are really important here as well. And to me, the highlight of this is really opening up the 401k marketplace to private capital. It's a place where I think it's really well suited for that, because it has the opportunity for an institutional control layer as well as access to millions of participants, retail investors on the other side. So it's a way with the right technology, the right fiduciary standards, the oversight. It's to open up apertures for defined contribution participants to really get access to more diversified portfolios that include private capital. So I think that's where we're going to see a lot of the the change happening there, and of course the regulatory side is helping open that up. And interestingly, we've done a lot of analysis here, and the European markets are typically a little bit ahead of the U.S. market in terms of allowing access and achieving access investments from the pure retail side, not the high net worth side, but the retail side, into these private capital investments. So I think what that shows is there's headroom in the U.S. for a really effective transition or increase into more private capital in hands of retail investors. It's being done elsewhere, and it really hasn't caused any problems. So if we go to the next slide. Here we're talking about M&A, and I think M&A deal activity is way up, and I think part of that is growth, trying to fuel growth, trying to get complementary product sets. But I think another interesting piece, and we've seen mentioned, is on the wealth management side. I think it's one of the keys to success going forward, and there's been a really strong uptick in the integration and M&A activity for wealth management firms. So it's very active. We don't expect this to actually start to wane anytime soon. So new capabilities, fueling growth, and actually making sure that there's distribution to where these new products and innovations can actually get in the hands of investors in an effective way. And that sort of ties into the talent piece as well. So if we can tick down to the next slide, we did a talent analysis on a couple of different levels across the industry, looking at job postings, thousands and thousands of job postings. And one of the things we saw was the two areas where there was significant change in the number of job postings in investment management. The first being in fundraising. So goes to this whole point of how do we get new capital into the firms. So fundraising is a big part of the talent change. And another part is this process improvement. And really, I think firms are thinking about that much more creatively than they have in the past. There are new tools in place, with AI, process change is different, and you can actually take tremendous leaps. So as firms are ramping up their process improvement skills, there are actually some sub-talents that they're looking for that are different than they have been in the past. And they're really, there's been a look at liberal arts degrees and incorporating those into the talent pool to get more creativity and sort of this thinking outside the box without the constraints of the past. And if we go to the next slide, we look at, so this talent is coming in a couple of different areas. So the AI related job postings are there, but then I think there's that added layer of this integration of the liberal arts graduates that can think about adding the technologies and not just repaving the same roads, but actually building different paths and using AI to help do that. And then I think as we go look at the next piece, this governance is emerging as a really important factor for AI development and growth. We're moving away from AI as these little one-off projects and thinking about it in terms of enterprise strength. And that means a lot to scaling up AI and really getting the benefits out of it in a broad institutional scale. And it's happening, and it's related to those governance talents and being baked into the process. So if we could cut down one more slide to the next one, please. So in the AI world, we're looking at a transition from experimentation and pilots and isolated instances where a sort of leading or technology focused group has taken AI and implemented it in their area to taking an enterprise-wide stance. So it's no longer experimentation and one-offs, but rather an overall implementation for AI. And in order to do this, the scaling and the governance and execution all really have to change. It's no longer a small group figuring out how to solve a particular problem using AI. It's okay, let's apply all of our AI learning to our organization. Let's find some things that we move forward and leverage those in ways that they can be leveraged across groups. And let's do it in a way that if someone asks us, what are our AI policies? It's not 32 different things depending on where it was done and when it was done in which group, but rather we have a set of principles that guide all of our AI implementations, and we're able to leverage and scale it that way. So I think this, coming up with a chief AI officer, for example, is an important part of that. And this is where the firms are headed in the investment management industry, is to bake governance into the process. That's the way to do it correctly, and I think it's the way you can scale it and be fully compliant and understand what you're doing, be able to articulate it really well across the industry, across its regulators and across the firm. So if we go down to the next piece, the next slide, there are really three big things that we're seeing. There's product and structural innovation. There are new wrappers, including new ways to use ETFs. In Europe, they're also redeveloping and revamping their approach, and we're getting into tokenization, and we're getting into a way that more illiquid or institutional type products are being made available in a responsible way. They're gearing up for that for retail investors, not high net worth, not accredited investors, but really truly retail investors like 401k participants. In order to do this, firms are going through a workforce transformation. So we're building skills in AI. We're not overlooking the fact that when we make all these product changes, we have to think about, okay, who's going to buy them and how are they going to know and learn about these products? How are we going to tell these new stories? And are we connected to those clients? And I think that's part of this convergence with the M&A piece as well. It's one thing to have real deep expertise in the private capital markets, but matching that with the retail investor is something that really is a new challenge. And I think firms are taking that very seriously. And I think that's where wealth management comes into play. And then I think the third piece down here at the bottom is scalable AI operating model. So thinking about it seriously on an enterprise level and being able to scale AI and take that innovation that was developed in these small, more avant-garde groups and figuring out the best practices among those, how to govern it, and then leverage it across the institution or the enterprise. And so that's getting you to a scalable AI operating model. So there's the overall. Now we'll go back into the ETF piece, where I'll hand the presentation over to Paul Kraft. Thank you all.
Thank you, Doug. Appreciate the trends and heading into the ETF, which is such a significant trend. So on our first slide here, it just magnifies what you all have been reading about and listening to with regards to the sizable opportunity here that I don't think can be ignored by fund groups as they move forward, and obviously hasn't been as many have made strategic decisions. But just from Deloitte's Center of Financial Services, we predict that the active ETF market will grow to from about 856 billion in 2024 to 11 trillion by 2035, which is a 13 times increase, which is obviously significant. We're starting to see that on the chart on the right with regards to the active ETF AUM, expected to account for 27% of the total ETF market, as well as continue to take on a larger percentage of the total AUM in the long-term assets, and surpassing active mutual funds AUM by 2035. One thing that just jumped out at me, we're going to talk about the active ETF landscape in a minute, but just 2025, there were only 95 mutual fund launches, which is the lowest since the Reagan administration, which I found to be incredibly interesting, since 1993 or 83, when there was 75 funds rolled out that year. Only 201 in 2024, and that compares to over 1,000 ETF launches, active ETF launches in 2025. So you're really starting to see the implications of this trend as we move forward. So if we want to go to the next slide, Again, the investors obviously are very attracted to active management capabilities at a lower cost, which is a significant benefit of the ETF, as well as the ability to trade throughout the day, which is an advantage as well. I think they're between the consolidation and the continued growth, we'll continue to see the trend line. With a surge in ETFs and new launches, we'll continue to see that trend line overtake the AUM that mutual funds currently hold. Again, everyone kind of understands the makeup these, the generally available at lower expenses, which is comparable to mutual fund. They have lower admin fees, marketing fees, distribution costs, less than that of a mutual fund. The one holdback is the third column there is they're not ideal for DC plans yet due to the current infrastructure and not being able to handle the plan sponsors not being able to handle the intraday trading and not really needing that with regard to their infrastructure. So I think that's where the headwind is, but it's also where there's a significant opportunity as we move forward from an industry perspective. Doug hit on this, AI and technology advancements may soon make ETFs and more viable for DC plans, as well as I think we're obviously going to talk about ETF share class opportunity. So just again, setting the stage for the next slide, which I would call more the money slide, and where all the activity really is, right? So that chart above really does summarize where we have been and the dramatic movement with regard to active ETFs and the opportunity. So if you just look at what's happening with regard to the top two lines are just old-fashioned launches. So the Deloitte did a paper about a year ago with regards to what's your ETF strategy, three paths to success. And we really have seen success in all three of these paths. So the first path is obviously the old-fashioned, let's launch a ETF, get into the business. And you can see where those have continued to accelerate with the first line just being ETFs in general, and the second line there, the 937 in 2025 being active ETFs. So again, tremendous growth with regard to launches, and I've referenced the lack of launches on the mutual fund side. Conversions of mutual funds to ETFs. So this is something that continues to grow. We thought it would maybe plateau a little bit while folks thought about ETF share class, but they continue to see conversions, and we'll talk a little bit about the what that means and kind of what needs to be done there. And then the ETFs, obviously there's the 80 firms, unique firms have applications in, of which I think 31, probably changing as we speak, have been granted SEC approval. So tremendous opportunity with regards to ETF share class. So maybe jumping back. So with all of these, there's obviously challenges, and you need to be set up. So with regard to the launches of ETFs, those that are traditional mutual fund shops, there's obviously plumbing and requirements and operating model infrastructure that needs to be set up. In all three of these paths to success, you really need to focus on the relationships. Relationships are similar to what we service providers are key. But with an ETF, obviously you've got active participants, you got market makers, you've got other players that are crucial to the success of your ETF business. And then internally, you also have the need for capital markets specialty skills. So as Doug mentioned, talent, I think great here, especially if there's a advent of a lot of ETF share class launches, the quest for talent in the capital markets area is going to be quite competitive as ETF business needs those specific skills in-house to help work with the market makers as well as the APs. With regard to the conversions, I think one of the things that used to be an impediment was, obviously if you're a mutual fund, you don't need a brokerage account. So that was, has been overcome, and the conversions again continue to be moving forward. With regard to the ETF share class, I think there's a lot of things that folks are thinking through. There's obviously a time element here of all parties again needing to be ready. Some won't be ready till next summer, so there's a little bit of a delay with regard to the ability to launch these. There's also the idea that the distributors need to work out details with regards to how the ETF share class will be distributed more broadly. So there's certainly challenges with that and some decisions that need to be made. But I think when you look at the key considerations for ETF growth, we certainly see that developing a robust authorized participant network is key. Again, relationships and really there, I think it also is imperative that to be successful, you really need to bring in a seasoned ETF leader. And that leader brings with him or her experience of dealing with authorized participants, the markets, understanding basket creations, etc. So a key element to success and the probability of success is obviously going to be bringing that leader in. You also know in the industry, it's a highly concentrated industry with the largest 10 ETF players accounting for about 25% of AUM today. So it is a challenging environment. But again, we've seen firms start up, launching, and be successful. Obviously, again, relationships matter here with regards to selecting custodians, scalable capabilities, which is terrific because there are a number out there that have been operating for many years now. And so the opportunities there. With regards to having a strong perseverance with regards to developing a comprehensive marketing and distribution plan. I think it's imperative that you understand that it could be a slow growth trajectory early days, and you're in it for the long haul. So that commitment to the ETF business is imperative, and making sure you have the platform and the strategic decisions made around marketing and distribution to move forward. And then obviously there's also we talked about talent, but there's also the effective and efficient operating model that can take into some consideration some of the digital capabilities that exist today that'll widen your and enhance your probability of success. I think when we talk about the ETF share class, again, I think we're talking to a lot of folks with regards to making sure they're working with their service providers to be able to tweak their traditional environment and operating model to accommodate the ETF considerations that are numerous. When you look at kind of the overall ecosystem, the life cycle of an ETF, it really does cover and impact all aspects of the business, from front office, middle office, back office, reporting, etc. So you really need to think about different parties, again, counterparties, service providers, that you'll be getting different reports, different types of information coming through. And it takes time, again, to be able to do that. Again, working with the front office with regards to the importance of capital markets talent and relationships with the AP and market makers. One of the industry headwinds that's out there is this idea that there's not an unending supply of capital, right? So if you want to have somebody savvy in the capital markets area who is working with the counterparties, the market makers, the APs, to be the first or second call position, to be in a position of success. So you want to make sure you have great relationships with those folks. Governance was also mentioned earlier. It's imperative that the boards, as they look at the ETF share class, there's a number of conflicts of interest that boards and management will have to work together. Currently, the applications call for the need for management to put forth a plan to articulate why this is going to be beneficial to both the ETF share class and not disadvantage the mutual fund share class. So whether that's through scale or et cetera, but you've got brokerage expenses to think about, cash drag problems with regard to redemptions, tax liabilities, things of that nature. So it's really looking at it from a different lens, from a governance standpoint, and there'll be a lot of work that needs to be done to make sure that boards and management are aligned and there's no expectation gaps. So let's talk about kind of the current activity with regards to the 31 firms that are moving forward. Some are faster than others, obviously, but there does seem to be a movement to get to this summer and see what happens with regard to other industry players being ready to launch, and then again working with the distribution channels. But I think there is a benefit to figuring this out to make sure that the ETF class process works and your vendors are ready, et cetera. And then some of the, we'll say, Reg BI issues, distribution issues, maybe sort of longer term issues that the industry will be dealing with as things move forward. But getting that operating model, plumbing all the talent in place is going to be imperative as folks move forward to take advantage of the ETF share class. So next slide. So sort of what's next, with regards to, continued growth in the ETF market is expected. You can go to the Q&A slide, sorry. And again, I think we'll be, interested to see how all the parties come together to make the primarily the ETF share class a successful offering. With that, we'll pause for questions.
I don't know if we have any in the queue, Paul. I was just wondering, what's your impression, Paul, of how much effort it takes? How difficult is it for firms to make this change from traditional mutual fund manager to being an ETF provider?
Well, I think there are a number of headwinds, like I mentioned, with regard to talent, with regard to different processes, nuances of the product. Again, if you look at the three-way success, I think each one presents itself with its own challenges. The good news is there are a lot of great partners out there, relationships that you can align yourself with. There's the other opportunity. You talked about M&A. There are opportunities to buy ETF businesses to expand that way. But I think the good thing is there are a lot of folks out there doing ETFs, so it's a proven process, proven life cycle of areas that you need to address in your operating model.
Yeah, thank you. And so if we go, the next webcast is going to be on February 19th, and it's going to be the Investment Management Regulatory Outlook with Megan Burns and Maria Gattuso. Tune in for that if you can. And thank you for tuning in for this one today. Appreciate your time for listening. Take care.